This week, the world is hedging again. Gold is up, the dollar is stronger, yields are slipping, and volatility is back on the board. But the story isn't panic. It's where capital chooses to hide when confidence cracks. Whenever markets lose confidence, money doesn't disappear. It migrates. It leaves assets that depend on growth and moves toward assets that depend on enforcement. Liquidity runs to the US dollar, trust flows into gold, and volatility rises as investors pay for protection. US Treasuries still anchor the global financial system. They're the contracts the world believes will be honored, no matter who's in charge or what headlines hit. In a crisis, yield matters less than credibility, and that's what the world is really buying. This week's stress has a few clear triggers. First, China is once again tightening its grip on rare earth exports, the elements that make modern technology possible. The move isn't about revenue, it's leverage. By controlling over 70% of global rare earth processing, Beijing can move markets with the threat of scarcity alone. The signal is enough. Western manufacturers have to react before shortages even exist. Meanwhile, in the United States, new tariff talk from Donald Trump is stirring the inflation debate again. Tariffs act like a tax on imports, and traders price them in the moment they're threatened. Add to that the noise around his Supreme Court case, and you get another layer of uncertainty. Not economic risk, but institutional risk. The fear that the rules themselves could shift. When headlines like these hit, investors don't just run from risk. They start a credibility search. That means capital shifts towards systems that can still enforce promises. It's not about who's most moral or most efficient. It's about who can make repayments certain. The dollar, treasuries, and even gold all benefit from this credibility premium. They're backed by enforcement, by liquidity, and by belief that someone, or some system, will make good on the claim. For decades, U.S. Treasuries have been that anchor, the world's preferred collateral, trusted to pay on time and trade at scale. But that trust is no longer absolute. The recent sell-off after the Liberation Day tariff announcement was a reminder that credibility has a price. With deficits widening, issuance surging, and long bonds yielding barely more than cash, the market is beginning to question whether Washington's guarantees still justify the same premium. The dollar and treasuries still sit at the center of the system, but increasingly by inertia, not faith. Investors are staying because the alternatives are thinner, not because the U.S. balance sheet is flawless. What's important this week isn't what's happened. It's what's been threatened. The threat of tariffs, the threat of export limits, the threat of political chaos. Each one shifts behavior long before any law changes. That's the real engine of modern markets. Credible threats that cause preemptive compliance. Traders, companies, and even governments act to avoid the penalty before it's real. In this system, the threat is the policy, and credibility is the currency that makes it work. Thanks for joining us on Capital Prism. Please subscribe and stay curious.